I think we'll get going. It's 11 o'clock, even though the people still arriving. Apologies to Andrew. We have got him on this morning, but I forgot to put it on the front slide. But before we get to Andrew McHattie, I'm going to run through a bit of news. And then after Andrew, we're going to be talking to Ross Greer of Next Energy Solar Fund. So there was quite a lot of news to look at, but I was kind of conscious of time, so I've just restricted it to two stories. So I'm going to be talking about the battery funds, Gresham and Harmony, and also Digital 9. I'm going to cover off the Harbourvest Aberdeen Private Equity story in a piece that I'm writing for our website, so our normal kind of QD view. So that'll be up on the site later on today. And Chrysalis, I think, is worth looking at too, but we are actually writing a note on that, and so hopefully that should be with you relatively soon. So batteries. So you can see the share prices of these have just collapsed. So Grid, this is last night, was at a discount 60.5, and Harmony at 51.3. Gresham's just starting back and buying back some shares this morning. I'm not sure whether it's going to make much of a difference. We'll have to wait and see. But these have been on the slide for a while now. But this sort of latest move is obviously quite sharp, and it's obviously related to dividend cuts. So Gresham said in September in its trading statement that there were revenue issues and pointed the finger at National Grid. And then when it put its interim results out on the 27th, it made it clear that it was the low utilisation of batteries by the National Grid and its balancing mechanism, which we'll explain a bit more in a minute, was affecting the whole industry. Nothing's sort of come good since then, and so it has decided that it's not able to declare a dividend for the final quarter of 2023. And it's also saying we've got to rethink the whole approach to dividends going forward. So the heavy hint is there that there's probably sort of permanent dividend cut going on. And then this morning, Harmony came out and said something very similar. So they basically said the reduction in their income was far faster than they'd expected. Although it had enough cash to finish what it wants to build, it's not going to be able to pay its first dividend, and then we'll have to wait and see what happens with the rest. So in terms of where these funds are earning their money from, there are little contracts that get given out by the National Grid that, to start off with, were quite lucrative. So you do things like just supply little bits of power to try and keep the frequency on the grid within the acceptable tolerances, so it didn't kind of trip anything. And then you get contracts for doing that. And they were sort of let on a regular basis. As there's been more and more battery storage put on the system, everybody's kind of competing for these services, and the value of them has been driven down. And this is something that all the funds knew was happening. They already acknowledged was going to happen, but they were saying, we always saw this coming. It was always in our models. So this is not the problem. Then there's the capacity market, where basically ahead of time, a year ahead of time, 4 years ahead of time, the grid arranges to have supply available if it needs to. And again, you kind of bid for these contracts on an auction basis, and then it will give you 4 hours notice to say we need your power, and you'd switch that on. And those revenues are still quite reasonable, but they're kind of flat. They're not going up or down, and that's going to just carry on going as is, really. The balancing mechanism is a sort of something similar to that, basically, but it's some more short term. So it's applying power to the grid when needed, and also absorbing excess power when the sun's shining and the wind's blowing and everything's generating. We sometimes have too much power, so you agree to store that. And then it's kind of akin to what's going on in the wholesale market, where you're actually deliberately trying to buy low and sell high. But we've done under the basic mechanism is done under a contract with National Grid. The centre of all this is this National Grid ESO. The big problem we've got is that its systems are just not fit for purpose. They're not really set up to cope with the battery storage systems. And it knows it needs upgrades. And the industry has been pushing it to sort this out. And this is a page from the National Grid's ESO's website, and it's just talking about what it's doing within balancing mechanism, what the various bits are it's trying to do. It's a very busy slide, but really, it's these two things here that are the key, really. It's actually sort of missing out this immediate step we'll talk about in a second. But it's got some work to do to sort stuff out. Once it's done that, it's going to be easier to use battery storage on the system. So again, the industry sort of saw this coming. In July 23, they wrote to the ESO saying, look, you've got to sort this out, then do it urgently, because we've putting on an awful lot of capacity. We're paying billions of pounds to do this, and you're locking us out of the ability to actually earn money out of this, so the balancing mechanism. So the first step for this was to implement a software upgrade in December, where instead of calling on battery storage projects one at a time, which is obviously pretty much impractical, they could call on multiple battery projects simultaneously. They launched it, it fell over within a few days. It took another kind of month to sort out, and this is only really working now. So there's been no benefit of that at all in the numbers that you see. What's coming in the spring is what they call a fast dispatch thing, which will allow the grid to demand power from battery storage more quickly, which makes it more useful to it. All well and good. We think that would be all you need. But actually, at the moment, and I don't really understand how this must be the case, but the only way that it can accept power from battery storage is in packets of 15 minutes. And it needs the power for longer than 15 minutes. So basically, it is skipping over the available power from batteries and giving it to other suppliers instead. And so until that gets fixed, that is the big thing that's holding back revenues. So instead of calling on power from battery storage, they're calling on it from gas-fired plants, which can fire out reasonably quickly. And it does mean, of course, that the main driver of prices, it just accentuates that the main driver of prices is gas. Gas prices have been much lower than they were. They're much less volatile than they were, although it's still relatively high. And because basically the grid is taking gas and paying it a higher price than the batteries are prepared to sell it at, they're keeping the price artificially high. So the price of power is being held up artificially high and relatively flat, much more flat than it would be if it was allowed to just trade in kind of normal volatility. That's not great, because that reduces your ability to earn revenue from power price arbitrage. And so it's also not great because it means we're burning more fossil fuels, and it's also not great because it's pushing up prices for consumers. So they does need to get sorted out, and I just think it's ridiculous that it hasn't happened already. The problem is that nothing is going to get meaningfully different until we get to 2025. So late 2024, we get this improvement in the system, assuming it works, but given the previous track record with the last upgrade. If it works and it all comes on, then basically there's a whole extra stream of revenue that would come on, which is great. And you might get more volatility in the daily power price stuff, which means you have more opportunity to make money for the wholesale market. So the profitability of these things could just ratchet straight back up again. But in the meantime, they're trading at enormous discounts, and they won't be able to pay dividends realistically, I think, for most of this year. So I wouldn't surprise me if somebody comes along and just says, "Oh, I love that. I'll offer you 30% discount to NAV. Isn't that quite reasonable?" And people just go, "Yeah, yours." But that would be a huge mistake, because these things, as I say, will come back. So there we go. That's the batteries. Digital 9 is worth mentioning too, because obviously long saga, we've talked about this in the past quite a lot. The share price is carrying on sliding. It's now an enormous discount, almost 76%. But but they've now concluded their strategic review and decided to implement a managed wind down, which I think probably wasn't a great surprise. I think it was all sort of the direction of travel. Shareholders still get to vote on this, and that will happen in a few weeks' time once they publish the circular. What it says is because they sort of taking this decision now, they're going to start prepping the businesses that they own for sale, but that will take a while, so they won't actually launch kind of the sales process until later this year. I think there's a heavy hint there that you're not going to see disposals happening until the back end of this year. And even then, Arqiva, which is the towers for broadcasting channel TV and stuff in the UK, isn't going to get sold yet. It's just not ready to sell. The implication of what the board said, I think, is that they're thinking whether if we just sell everything else and spin this out, whether that's the problem, whether that's the solution rather. So we could see that. Burn sales going on in the background. When they sell one or more of the other ones, they'll use the balance of that to pay off their revolving credit facility, the RCF. So it's sort of 365 million. The 300 million of the Verne money is going to come and pay off some of it. Some has been paid down already. So quite quickly, there'll be no debt. So that massively de-risks it. There'll be no dividends in the meantime, and there probably won't be any more ever. They're saying they're not sure whether they want to repay some of the Arqiva debt or not. That was all refinanced recently. It used to have an inflation-linked coupon, but now that's been capped because obviously that was getting quite expensive. But the inflation coming down, I guess they might be room for more renegotiation on that. They've given notice to the manager. They're going to give notice to the manager, but not yet. So everything's sort of hinting towards some conclusion in 2025. The Verne sale hasn't actually gone through yet, but they are expecting it all to be approved by the end of March. And that should say on track, so not on rack. There is a $25 million deferred consideration that's linked to them signing a new power agreement. That's all on track as well. So that's probably, if that comes in around the end of March, that's sort of end of April, beginning of May. I think we've got a little bit more bad news to come in that there'll be another valuation, and I think it's almost certainly that the NAV will fall, and that's going to come in a few weeks' time ahead of the announcement of the final results. The problem we've got for winding all this up in a hurry is that the final sort of earn-out bit of the Verne Global thing is not going to get paid till 2027. So I think there's a scenario where you spin out Arqiva, you sell everything else, you repay all the debt, you give out the excess cash, probably then doesn't need to be listed, and then shareholders just hang around. They've got shares in Arqiva, and they've got this thing that's in liquidation that they know they're going to get a payout whenever the final Verne Global thing comes in. All of that together, I just think that 75% discount is probably going to be way too high, but just bear in mind there's probably more negative news to come first before we get anything. The good news starts to roll in. Good. That's enough from me. Let's hand over to Andrew.
Lovely. Thank you. Thank you, James. Lots of bad news for dividend investors there. Well, January was a funny month, I think, because actually, if you look at the sector average and the index for that, it was pretty flat. And the change in the average NAV discount was also quite small. So you think, well, not much happened. We know that was definitely not the case. So actually, in terms of individual movements, there was a lot going on. And let me inject a positive note after James's section there. There was some modest recovery in growth capital. I think a little bit of optimism did prevail at the start of the year. And we've seen that come through most forcibly, certainly with Seraphim Space, which has had a very big jump this month, quite a lot of nice media coverage of that trust. And we've also seen Hydrogen One capital growth moving around, quite a lot. I mean, it's a very volatile share, that one. I think if you are a trader of investment trusts, and that's not really why most of us are here. But if you are, that's a really interesting one to look at. Quite a few very specific stories here, like Baker Steel Resources, which had an uplift in its NAV because it revalued its unquoted assets. We saw that one coming. Geiger counter still being driven by the uranium price. So quite a lot of action. The ones I'll talk about are these two, Tufton and Crystal Amber Fund, which I think are two interesting special situations. The fallers, obviously, James has covered the three at the top, or the two at the top, which was a very significant decline, and I think it was quite shocking actually for many investors who hold these trusts. There are also, quite a few relatively sharp declines across the property sector, a couple elsewhere in the renewables space as well. So it was a tough month. China's on there as well. So whilst the index may have been flat, actually there was an awful lot going on under the surface here. I will also talk about the battery trust because I think the falls are of such significance that I can't ignore them, and also Custodian Property Income REIT, which is on the list. So coming back to the positive side, Tufton I think is a really interesting situation. I'm not sure how many people will own this because it's really on the fringes of the investment trust sector. It's also had a very tough time of it, actually. In 2022 and 23, we saw a fair decline in the shares. And I think a lot of that was down to disappointment that China was not recovering more strongly because, a lot of the revenues here are based on the amount of global trade and the shipping rates. So I think there has been quite a lot of disappointment factored in here. And now I think we could be reaching an inflection point. And I'm always a little bit ambivalent about talking about this kind of thing, but this trust could be a beneficiary of some of the trouble that is brewing in the Middle East now, and the tension in the Red Sea in particular, which has seen shipping rates actually bounce up very strongly, and that can help the short-term revenue here. Already, the trust has announced a higher NAV for the end of the year, and it's raised its dividend target for this coming year to 10 US cents, which actually implies a dividend yield of 9.3% on the current share price, which I think is a pretty attractive yield. And they say it will be covered 1.5 times by revenue. So if you are needing to rebuild some of your income because it's been hit by some of these dividend cuts elsewhere, this is maybe one to think about. And there's an extra factor here, which is that the trust does have some excess cash. It's planning a one-off return of capital to shareholders in the second quarter at NAV less costs. So again, you're getting an uplift there on a small part of your shareholding if you own this. To my mind, there's enough there to justify some considerable narrowing of the discount, which is about 25% now. And it seems to me that this trust maybe hasn't received quite the attention it deserves. The other one in the sector, Taylor Maritime, is on a bigger discount. That's in a slightly different situation because it's paying down its debt. But nevertheless, obviously, some of these same factors come into play there when it comes to the shipping rates. Crystal Amber Fund, next. I've talked about this one before. It's in the process of winding up and came out of its main holding in Hurricane Energy earlier in the year. And it repaid 25 pence of capital to shareholders. That's what the big decline in the middle of the chart here is. So it's not that the shares suddenly dived. But it's still on a big discount of 22%. And I think, again, there are some positive factors here. It has a very large holding in De La Rue, the banknote printer. If you look at the share price of De La Rue, it's been really strong of late, actually. So the NAV, I think, is on its way up here. The trust has also extended its buyback program. And, I think it's reasonable to be a little bit skeptical of the impact of some buyback programs. But in this case, the shares are not massively liquid. And I think, actually, it probably is having an impact. The top line there is quite intriguing that Saba took a stake in Crystal Amber, one of the many it was, where it was hoping for a discount narrowing. That hasn't really happened very much yet, but Saba has reduced its stake somewhat, but it still holds 20%. So that's still very much a factor here. I think this story is still unfolding. And there's also potential here for an extra bit of revenue to come from Hurricane Energy, some deferred consideration from that deal if the earnings hold up well. So again, I think a few moving parts here that, to my mind, are generally positive and could yield some extra value. Now for the negative bit, battery storage trust. Well, this is a very similar chart to the one that James showed. It's a one-year chart with Gresham House in black, Harmony in blue, and Gore Street in green. You can see this plunge has been really dramatic. And I think inevitably, when this kind of thing happens, we all ask ourselves the question, should we have seen this coming? And to some extent, as James outlined, the trusts themselves did. But I think actually they feel as though they've been worked over by National Grid here, that this new algorithm that National Grid is using, effectively cutting out the battery storage trust, was really quite unexpected. And I don't think it was really intended either by National Grid. And so that raises the question about how quickly it may be resolved and changed. And I think that really is the question we need to ask ourselves. And one thing I've been thinking about here is that really, since they were launched, these trusts have changed their revenue models over and over again. It's not been a very stable mix of revenue that they've been getting from all of these different revenue streams that they have. So we've seen them switch around before. And usually when they've switched, it's been quite beneficial. But now, of course, all of these streams have suddenly, stopped at once. And I think that's not something National Grid intended. I mean, they do need to have these battery storage capabilities. So they need to make sure that these companies are incentivized to continue. And so my feeling is that actually the revenue might come back quite strongly when it comes back. So if you are a holder of these trusts feeling very disgruntled at this time, my feeling is that you're probably a bit too late to sell out. And if you can stomach holding these while you're not being paid a dividend, actually, I think, we might see a very different picture emerge, possibly more quickly than we currently think. One other point I do need to make, I think, is that they're not the same, these three trusts. Obviously, it's Gresham and Harmony that have come out with the announcements about the passing of the dividends. And at the present time, it seems as though Gore Street will probably tough it out. I heard that's what one broker said. And the reason for that is to do with this revenue mix, that it's only getting 19% of its revenue from GB. It's getting 50% from Ireland, 27% from ERCOT, which is Texas, and then a bit from Germany as well. So because of that revenue mix being much less based on GB revenues, it does have some protection there. And I think Gore Street may well come out of this a little bit better than the other two. And that's why its shares have not fallen as sharply, although it has been a casualty as well of the sector decline so far. Finally, Custodian Property Income REIT. I'm a bit puzzled and intrigued by this one, actually. It's had a sharp fall in its share price this month, down 18%, which was really triggered by the news of its all-share takeover merger with Aberdeen Property Income. And it's not uncommon for the acquiring company to see a fall in its share price, but this seems to me much sharper than I would have anticipated. And this is a bit puzzling because actually the deal does really make sense, that it'll add a lot of assets to the trust. It'll grow very substantially, and it should have benefits to come from scale and reduce costs. And it makes sense in terms of the overall consolidation of the sector. And you do need to have these stronger players actually making these maneuvers. But it's really been clobbered. Now, because it's an all-share deal, this means it's now paying considerably less for the Aberdeen Trust. And actually, if you work through the figures, the offer price for the Aberdeen Trust has now come down to about 54.5 pence a share. It means they're acquiring the assets there on about a 29% discount, which I can't really see how that's bad news for the Custodian Property Income REIT shareholders. But I do think that it could be that what's happening here is that the market is discounting an overhang of stock because there's no cash element to the deal at all. So the Aberdeen shareholders, if they don't want to continue, they're going to be selling their new Custodian REIT shares when they get them. Now that might happen, and it may be that there's a bit of fluidity in the shareholder register. And historically, Custodian has traded at a premium to the rest of the sector, partly because of the makeup of its shareholder register I was reading. So I think that raises the question of whether this is now a bargain because it's an unwarranted sell-off. And I think you could definitely make a case for that, or whether actually this has been a tactical error by the company because it's buying maybe some assets that are regarded as slightly lower quality, and it's also disrupting a very good, stable, supportive shareholder base. So, I'd be very interested to see how this plays out. And the reason for highlighting this is not just because I think there could be an opportunity in these individual shares, but also that it may have implications for the rest of the sector and the willingness of other property REITs to undertake these kind of transactions. Because if you're getting rewarded with a 20% drop in your shares, that's not going to be that attractive to other boards. So I think there's quite a lot of questions here, and it probably one we'll come back to. Good. I can't see any questions, so I think that's it from me, James.
Great, thank you, Andrew. Yeah, I mean, to be honest, I do wonder if you're a API shareholder, whether you just want to say no, actually, given where the bid is now. But yeah, we'll see.